Welcome, everyone, to episode 35 of Top of Mind with Hao and Chris. Join us today to talk about regional bank weakness. Regional banks still are pressured. I've got an update with something I just received in the mail from a credit union on CDs. If you have not listened to episode 34, tune into that. We outlined the craziness that is happening in the CD market right now. Big tech earnings has been released. Was mostly good, but a little bit of a mixed bag with some of them. Retail theft is on the rise. You've probably seen this in the news. We thought we would unpack what we actually think that's doing to retailers and how they're responding. And finally, Series I bonds, which became incredibly popular a couple of years ago as inflation started to go up. We had a lot of clients buying these. The rate was going down. The new rate was released just a few days ago. It went up. Holy moly. How hot off the press today today, jobs report, and then a little bit ago, consumer spending. Could you just give us some insights with what's going on in the jobs report and consumer spending, and just how's the market reacting?
Yeah, well, I think it's helpful to set up how the market's reacted with raising rates or the specter of higher rates, right? Since I'm going to say August. So August, September, October have been pretty rough months for the stock market and the bond market, right? Everyone started pricing in higher rates or higher for longer at least, where we got a slew of strong data, consumer spending, retail spending. GDP was like nearly 5% annualized last week. Oh, and timestamp, November 3rd, Friday at 9:51 a.m. The jobs number came in today. The expected job gain was 170,000. We came in below that, 150,000, and the market reacted positively. So we're kind of in that. Yeah.
Can you tell us why that's good? I think it's counterintuitive, right? Because the past jobs reports, I think they were projecting like 250 and 350 were added. So can you share with us why it is good to be below that expectation?
Yeah, we're celebrating fewer jobs being created. Unemployment went up from 3.8 to 3.9%. That's mostly the interest rate story, right? The Fed has more incentive to slow down the economy if more and more people are employed, therefore more and more people are spending. And if they're not employed as much or able to job hop as they have in the last year and a half, there's less reason to keep rates higher, right? And that's what the market is pricing in. And we saw the 10-year Treasury go from 4.9 to 4.5 in the matter of like 2 or 3 days this week, which is the reason why November's off to such a like red hot start to the month. Again, the news cycle probably doesn't care about the turn of the calendar, but it's just really coincidental that it started on the 1st.
So in sum, the previous report said, hey, more jobs were added than was anticipated, and consumers keep spending at a ridiculously high clip.
Yeah.
That translates to the Federal Reserve or the market thinking that the Federal Reserve will likely keep rates higher for longer or even raise them higher than previously anticipated. And what happens is then the market sold off and interest rates actually went up to reflect the potential of future rate hikes or, again, higher for longer. What changed here in the last couple of days is the reverse. So fewer jobs are created than anticipated. That's why that's good news for the market, is now the market is saying, wait, maybe we priced in the wrong thing. Maybe this means that the Fed's previous work is working and the economy is actually cooling such that they can start lowering rates sooner or maybe not go up as high to begin with. So that's how you want to think about this, and that's why the market reacts almost inversely of these job reports.
In this environment, because we're in an inflation fight, all right? So the fundamental thinking is that inflation is driven by higher wages, more employment, right? Because people are gainfully employed, they're going to spend their paychecks on stuff. And if they're not employed, they're going to do the opposite, therefore prices go down. At least that's what the thinking is. So regional banks,
how's this impacting regional banks, or and I think interest rates are, but let's shift over to that. You said that weakness is continuing in regional banks and that the big banks just continue to rake in money and profits. What's going on there?
Yeah, so Chris and I have been talking about this since March this year, where regional banks are under scrutiny and under fire since, SVB and First Republic, where...
We just got convicted, by the way.
Oh, did they?
Sorry, SBF got convicted. Sorry, acronyms.
Yeah, SVB.
Saw that in the news yesterday.
Valley Bank. Yeah, SBF is making a lot of noise in the financial news, but we don't really address it because we don't have a lot of digital currency investments. But yeah, to the regional banks, Chris and I have been talking about this since March, how we predicted that it was going to create deposit issues, right? Regional banks have had to incentivize assets from either leaving or somehow attracting more assets by paying more interest, right? And we've all heard you could get 5% on your high yield savings, but that's a very selective group of banks. Like you go to Ally or Marcus at Goldman Sachs, institutions that need to raise capital versus JP Morgan, Bank of America, who really don't need more deposits because there was a natural flow of smaller banks to bigger banks for safety. And since they have all these new deposits, they don't need to pay 5%. But regional banks do because they're hemorrhaging money. So if you don't have money to loan out via deposits, you don't have a business really, and their core business is loaning. And the problem with loaning out money with rates so high is who's really signing up for an 8.5% mortgage? And that makes it like a conundrum for regional banks where they have to pay, to incentivize deposits coming in, a hefty 5% relative to a Bank of America that pays less than 1%. And they have to, on the back end, loan that 5% dollar out to someone who's willing to sign a mortgage paying 8.5%. And that spread is the 3.5% is the bank's profit, if that makes sense in a business sense, right? But they're not able to really do that effectively in this real world environment. One, because mortgage demand is really low, because we don't have a lot of home buyers right now due to supply or due to demand. Home supply and then demand for people who are unwilling to pay that high of an interest rate.
Okay, I have a host of questions. Is home demand really down that much? Like, I know that there are fewer mortgages being issued today than there were, and fewer homes being sold. But is it really down that much? Like, I think it's to say that no one is buying. Like, a lot of people are buying. A lot of people are selling.
Yeah, a lot.
Do
of
you
people
have any numbers on how? What is the drop in mortgage demand? Is it 20%? Is it 30%? Is it 50%?
Yeah, the drop in mortgage demand is semi-fold, right? You look at the new home purchases, like if I'm selling my home, someone is demanding a mortgage to pay for that home, right? That's one.
Right.
The other part is if I wanted to refinance my home, we pay 3%. We're not going to refi at a much higher rate. So that's the second part of the mortgage demand that has completely dried up. I believe that side of it, which has been the majority of mortgage activity since 2020, that's nearly like 90% drop off, which makes sense, right? Because you're not refinancing unless you have a really dire need to do it. Yeah. So that's one of the biggest things that banks have been unable to generate new dollars from, right? Because the transaction costs from a refinance is actually pretty valuable to a bank, to a traditional bank, right? Because JP Morgan, Morgan Stanley, and Bank of America all have investment wings. So if mortgage dries up, they still have many other tentacles of business and revenue coming in.
Okay, and then at the regional bank level, so their primary business is lending, but if lending has dropped off so much, why do they want deposits, or why do they need deposits, right? So the regional banks and the credit unions are the ones that are offering higher CD rates.
Yep.
the big banks don't need your money, so that's why they're not offering anything. But if the regional banks aren't lending, they don't need your deposits to begin with. So like, what's the disconnect there?
I think profit is a big component here. Regional banks are publicly traded, and if they're not profiting or growing their profits, that doesn't make shareholders happy. And you have to balance out survival versus profits, and that's a difficult equation to square right now for regional banks. Because if you stretch too far, you're going to extend credit way too far, and that's going to hurt you, and especially if we're really are headed for a slowdown.
Well, in regional banks, we know are now, and this is somewhat recent, but they're subject to higher capital requirements. So they're required to hold more cash on their balance sheet per dollar of loans. This previous regulation was banks that are above 250 billion, I believe, were all subject to the JP Morgan size, so higher increased scrutiny and stress tests and things. Banks below that size were not, and banks now below that size are subject to these higher requirements. So that could also be why they're incenting more cash, maybe even more cash than they previously needed, because they're actually required to gain that cash in order to have more collateral on their balance sheet to balance out the loans.
Exactly, yeah.
Okay, so this is super interesting. I got to grab this. Okay, so I got this in the mail. We talked last time, and for those that haven't yet listened to episode 34, we talked about CDs a lot on episode 34. We've had a number of clients reach out to us, and we're doing like some short-term investments for them. So it's CDs, short-term bonds, this kind of thing. CDs are really hard to find. We have a rate list. We can pull it from our custodian, and we can buy those CDs, right? And you'll see a bank that'll issue with like a quantity of 20, and it's like, what, you guys are going to raise, $20,000 in CDs? Yeah, what's the point in that? You're a bank. This is a rounding error. And so this is a really kind of strange environment. So this is from Giza Credit Union. I had a car loan with them at one point. Actually, it was before they were Giza Credit Union, or Giza bought wherever it was before. Anyway, so I get this in the mail. We want to make sure that Giza provides you the best value, and we are upgrading your savings account, blah, blah, blah. Okay, industry-leading 7% APY, and also, that's only the first $500, of course, and then it drops to nothing. But they want my money for CDs. Get this. Okay, so this is a tiered schedule. They have 3 tiers: minimum balance of $500, minimum balance of $50,000, and minimum balance of $100,000. The 3-month CD, they'll pay me 0.25%, quarter of a percent. 6-month CD, 0.75%, and it's a little bit higher at 100,000 than it is at 500. By the way, it's 0.1% higher. Okay, 12-month CD, 5.25. Okay, now we're talking. By the way, that 12-month CD for $500, 0.8. You need to give them 50,000 or more to get that 5.25% rate. Interesting. 18-month CD. You would think it would be somewhere around 5.25, but it's not. It's 1.15. 24-month CD, 5.35, because that makes sense.
Yeah.
Also similar. So again, $500 for that 24-month CD, 1.05. 50,000 or more, 5.35. You get a 4.3% bump on it to give them more money. And then finally, just to round this out, 30-month, 36-month, 48-month, 60-month, 84-month, all these keep going, and it's 1.35, slowly escalating to 2.5%. What?
Yeah, so imagine when we refer to a yield curve, imagine a ski slope that just goes down and then flattens at the bottom. So the further you go out, it's just completely flat, and there's no incentive to go 7 years on a CD here. Especially.
So what's so weird though is that the 12-month, so basically no one would buy the 18-month, right? You're going to buy the 12-month at 5.25, which by the way is bolded. In case you couldn't read this, it's bolded, so that you can make sure that that's not a typo, because all these other rates are so silly low. So you would either go 12 months or 24 months. So I can't help but wonder what they're trying to fill in, right? They're trying to incent to fill in kind of the void in their deposits. But like, no one would give them money for 18 months. You would either go 12 or 24. And the difference between 24 and 30 is, 4%. You go from 5.35 to 1.35. Again, makes no sense. I don't have on here, I was trying to read the fine print, if that 24-month CD is callable. How you're seeing a lot of CDs right now in the marketplace are callable after the first year. And I don't know if that's the case here or not.
Yeah, so we do
Callable.
look through inventory, or what Chris describes, like 20 available. That's called inventory. And every bank puts out 100,000 here, 20,000 there. And all that inventory is tagged with a callable feature, meaning if I'm signing up for a 2-year CD, the bank's reserving the right to call that back and pay your principal after 1 year. What they're anticipating, most likely with the call feature, is rates will drop in a year. And why would they want us to continue to pay 5% when, let's say, rates go down to 3%? That would be the bank's dream. They would close that 5% deposit, which is essentially a loan from their point of view, so they could pay 3% versus 5%.
I'm just reading a little bit further here. High yield savings accounts, anything under 100,000. Guess what the rate is here at this credit union?
Under? For high yield?
Under 100,000.
I'm going to say 0.87%.
Close. Well, you were close because it had a 1 in it, but it's 0.01. So it's the same as you'd get at your good old, Chase B of A. You're going to get practically
And it's
0.
advertised as
0.01. Nothing for a high yield savings account under 100,000. Over 100,000, what's the rate?
I'm going to say 0.2%.
3%.
Oh, really? Oh, big jump.
So once again, very strange, right? But they're basically saying we want big amounts of money.
Yeah, bigger.
What I don't quite understand here is why the high yield savings account at 100,000 and above is paying 3% today, but then they have money market accounts, which range in roughly like $10,000 to $50,000 increases, and it goes from 0.2 to 0.45. I don't get that.
Yeah.
250,000 and above in a tier 6 money market, whatever that means, 0.45%. Why wouldn't I put it in a high yield savings account for 3%? Anyway, super strange what's going on right now. We'll probably, tell our kids about this in a bunch of years, but I've definitely never seen this weird of a rate curve. I thought when I pulled it up last week, or I guess 2 weeks ago when we were talking about this on the pod, it was Amex that was offering this wonky, like wave, like yield curve, and I was like, this is I've never seen this before. Well, now I've seen it twice.
Yeah, we're seeing it quite a bit. Again, you see in the headlines, just go with the CD. One, good luck finding one that you you trust from a bank, from an institution that's paying a full 5%. And two, find one that's not callable in a year.
If I was really wild, I'd just call them and say, how much money can I give you on that 24-month CD? And I wonder what their open quantity is. $1 million? Is it 20 million or is it 20,000? Who knows, right? Because that they have an open quantity on it. Anyway, let's move on. Big tech earnings. Kind of a mixed bag, but generally good. Can you can you give us a summary with what happened with our favorite tech companies here?
Yeah, let's start with Microsoft. They did really well. The real focus has been their cloud group. That includes Azure and SQL.
Azure.
They were Azure.
Come on, Hal, get with it. Azure.
I know the listeners are gonna wreck me through the coals.
I'm gonna comment on this video. Like, this guy doesn't. Anyway.
Yeah. He doesn't know how to pronounce Azure, but their cloud division is up. Azure. Their cloud division was up 29% versus the expected 26%. So this is like the biggest growth engine in Microsoft's kind of suite. Very diversified business, but that's been the focus, along with Amazon, with AWS, and I'll get to them, where that does good, the stock does good. That's probably what the market's only been hyper-focused on. Google dropped on earnings, good earnings, like they beat on revenue and profit, but they didn't grow their cloud. What's their cloud? I should know this. Their cloud division at Google was not up to expectations, hence a 9% drop immediately after earnings.
I their cloud division focuses on something different than
Yeah.
like Amazon and AWS and Azure are direct competitors.
Yep.
But then
Azure.
Google's cloud focuses on something a little bit different, and I would have to relearn that. But I know it's a different marketplace.
Similar focus though, where that's been kind of looked at as the high growth part of the business, and if that doesn't really meet expectations, the market really ignores everything else, because Google had a really good earnings quarter, like really good. Meta, same beats on the up, meaning revenue, and down, meaning profits, but they issued lower guidance on the Middle East conflicts, which again they got punished for that.
I thought so. They said lower guidance on future ad revenue.
Yeah,
Was it specific to Middle East conflicts?
they cited Middle East. Yeah,
Wow.
yeah, which seems like a very small region relative to the entire world in terms of who uses their services.
Yeah.
Right?
Right.
Yeah,
I do know that users in the U.S., although they have a lot of users in the U.S., it's a huge portion of their revenue. Users in the U.S. are actually less profitable than users in other countries, which is sort of interesting. I don't know if it maybe costs more to get people to click or something, but the whatever their number is, I don't know if it's a CAC or if it's something, but some sort of a conversion ratio is lower in the U.S. relative to other countries, which is interesting.
Yeah.
I want to say something else about Meta. All of these tech companies have done layoffs.
yep,
Meta has absolutely crushed it. They, in this last quarter, reduced headcount and increased revenue. Like it's the trifecta of we cut expenses, we grew our main product, and it all went to the bottom line. Every single dollar of that went to the bottom line.
and the market still punished them over weaker guidance.
Incredibly impressive, though, what some of these companies can do with their scale. So I just want to call that out. Carry on.
Yeah. Yeah, next is Amazon. Amazon had a really good quarter with AWS coming in line, meeting forecast expectations. So very good quarter for Amazon as well. And then today, November 3rd, Apple released earnings yesterday, and they sold off initially, but again, they lost 3% overnight, which $2 trillion company, $2.5 trillion company, 3% is a ton of money.
That's good perspective.
That takes a lot of weight to move. They cited a slowdown in China demand and slowdown in U.S. consumer demand for the upcoming holiday season. So Apple is not so upbeat about. They don't normally give any guidance. They just offered some really weak forward-looking language.
Which is typical for them, right? They're known as the sandbagger, right? They
Yeah.
sandbag their earnings and then they blow it out of the quarter. That's just kind of their MO.
So could be lowering expectations to beat. Yeah.
In other Amazon news, Amazon to close apparel stores as it shifts its focus to grocery. I'm a fan of that. Actually, I shouldn't say I'm a fan of that. I'm a fan of that because I happen to be a Amazon grocery customer. So I like to see more money going there. And but anyway, so they have these like style locations, which I haven't checked out. I don't even know if there's one here. Actually, yeah, there isn't. LA and Columbus, Ohio. Would love to know how you all figure out where to open your stores. To me, you should open them right next to your headquarters so you can just walk down there and check it out. But that's way too simple. So it's like, how do you figure out your test markets? That'd be fascinating for me to know.
Well,
anyway,
like
so you're
Columbus
closing those down.
seems like a low end. LA seems like a high end. Again, no dig at anyone who lives in Columbus, but you would think, what kind of Amazon offerings, like what percentage would they attract in LA versus pretty stark difference in Columbus?
Just cost of living, yeah. It's just cost of living difference. So anyway, shutting that down, they said that they will continue to invest in their grocery, which is all lines of their grocery. So it's Whole Foods, Amazon Go, the Just Walk Out shopping stuff they want to keep going. They said that they paused Whole Food investments because they were retooling some things last year. More self-checkout, changing some things around, but they're going to continue to grow that footprint. So I'm a fan of that. Also, Jeff Bezos is moving to Miami. So I I don't know if he's going to keep his 2 homes side by side in Medina. I think he lives in Medina. But he's moving out to Miami for, I don't know, better weather and greener pastures.
Yeah. I guess we'll talk about that as we find out more of the reasons why, right?
Yeah. Yeah. Let's shift over to retail theft. This has been in earnings reports at an increased rate. I know Target cited this. Walmart cited this. Seems like every company that has a retail footprint is citing increases in people stealing stuff, so much so that they're starting to have pretty big write-offs on their earnings report charged to lost earnings and lost products just walking out the door. You had some interesting thoughts and comments on this as we were preparing for the pod today. Could you share with our listeners just what your take is on retail theft and what's going on?
Yeah. So Chris mentioned Walmart, Target, big retailers have come out and publicly said organized crime is the reason for a lot of what the industry calls shrinkage. And shrinkage is just lost percentage for merchandise that they're unable to sell, whether it was stolen or was it misshipped or miscounted or damaged in shipping. That's all considered shrinkage. And the historical shrinkage rate hovers around 1%. And this year it's at 1%. So I think there's a big issue with what's being said. I think we both recognize that crime is a massive issue, especially in areas like mine and yours where
downtown Seattle.
Yeah, a lot of crime in the Sacramento Bay Area region in California. We're not glossing over the fact that there's issues, citywide issues. But I think if you look at what they're citing and what they're blaming it on, it doesn't really line up. What they're most likely glossing over is they just have too much stuff. I don't know, listeners, back in 2021, we started talking about this bullwhip effect remember when that Christmas season there was nothing to buy and it took forever to get like a couch. I don't know how long you waited for your couch.
Yes.
Like 7-8 months.
Okay, so yes.
Yeah.
And then we bought a different couch for this kind of other. Anyway, it doesn't matter. Not to replace that.
That screws
one.
my story now.
No.
Okay.
I'm telling you, I'm helping your story. I'm helping it. So the first couches that we bought took, 7 months, at least 4 months. Anyway, it took a long time. But then we just ordered a couch from a different place, just for a different room. We were replacing something, and it got here in like 4 weeks, 3 weeks. Like it said, available to ship, and it'll ship soon, and it showed up. And so, I remember those days, and hopefully those days are close to over.
You remember when we talked about the bullwhip effect, where the further you go up the supply chain, the smaller bottlenecks create these bigger bottlenecks down the line. Well, the bullwhip effect works in opposite, and we mentioned that when a Walmart or a Target places an order, if it's delayed and demand ebbs, you still get that order. Then suddenly you have an inventory bloat. I remember we went through that whole list where Crocs, Lululemon, Yeti all had tons and tons of inventory just sitting in warehouses, right? That costs money. Mm-hmm. And I think what Target and Walmart during this cycle are glossing over, and they're trying to sweep under the rug, is Target has a 36% year-over-year inventory bloat. They got too much stuff sitting in their stores. And people are slowing down goods purchasing. I know this kind of goes counter when we started the show when we're saying people are spending too much, right? And they're gainfully employed and spending all their paychecks, but they're spending on services. They're not buying Target goods, at least at the clip that they've been buying in the last 18 months, where the scarcity isn't as pronounced, but Target has all this inventory order that's sitting empty in the stores and in warehouses, which is super, super costly. And I think when they have poor earnings, I think inventory bloat is one part of it, right? Going back, I know we started with retail theft and shrinkage, but I think that's the issue of people not buying your stuff. For one, it's just sitting there on shelves waiting to get stolen or waiting to get damaged or waiting, whatever the case is. That should be considered on the company's bottom line, and that was neglected during earnings calls. The other part is self checkout. I know this has been a bugaboo, and I hate. I actually like self checkout, but I hate it in certain places. But how many memes have you seen? And I'm using an exaggeration. People scan a banana and walk away with a TV. What Target employee is going to stop someone who scans a cheap item and walks away with an expensive item? Right? Do they have the labor power or the people power to prevent that? Because they've been actively, for lots of good reasons, right? Because they just can't find enough qualified people to work in their stores, which is why they've had to institute a lot of self-checkout stations, because they can't find enough cashiers, right? But what comes with that is people stealing without stealing, in terms of like shoving cell phones down their trench coats, right? Like self-checkout doesn't really stop you from stealing. And that's another piece of it that is being cited, where this push to automation is causing, shrinkage, because people inadvertently walk out of the store like they're not stealing. Well, they not borrowing either, but you know what I mean? Like they had something in the cart, they forgot to scan, and they walked out. That should...
I mean, what solves all of this is just walk out technology.
Yeah, just walk out. Yeah.
Put it all in your pockets.
Yep.
And then walk out with it. And we'll bill your credit card.
I think what you're saying, and again, we'll get to the employee stress too, because CVS is suffering through employee walkouts because they're getting stretched thin. I don't know if you've been in CVS lately. They're a pretty massive store.
Yeah.
But normally only 2 or 3 people working.
Yeah.
So they cited danger, right? Like if someone's stealing, you're not supposed to get in their way or touch the person for liability reasons, right? So, and again, it's not your stuff that they're stealing from; they're your boss's stuff, which again creates another issue. You don't really care about the company you work for because either you're stressed or you feel you're underpaid or whatever the case is. I think that a lot has to do with that. And then the next biggest thing, probably where the biggest source of shrink is, employee internal theft. We've had people cited for citing like warehouse workers taking full pallets off the warehouse and stealing like...
What?
Yeah, it's entire pallets of merchandise.
So put the biggest an air tag on everything.
Yeah, the biggest theft is internal.
The biggest theft is internal?
Yeah. The biggest source of theft is internal. Again, that's still anecdotal, but I think because none of these companies report specific types of theft or loss, and I think that makes it difficult.
It is interesting because I feel like walking out the back door with a TV is probably easier than walking out the front door with a TV. Although you would look really strange walking out the back door with a TV because what are you doing? But if you're the one closing, that might be an interesting...
Yeah, I anecdotally, I have a friend who used to work at a mall retail clothing store, and his job was to go from store to store and investigate loss. And he said the majority of loss was from employees that he's interrogated.
Jeez.
Yeah. So
okay, but I heard also that you're kind of thinking that this is a bit of fun with numbers from the accounting department.
It is
because you were saying that historical loss ratios are 1%, and today they are 1%. So you're saying that earnings is just like basically it's the CEO saying like, hey, accounting department, how do we make our earnings sound better than they really are? Because they're not very good. What can we highlight in here? Well, people are stealing stuff, but it's not increasing. Well, let's highlight that. That makes us, right? That's kind of what you're saying.
I think the biggest thing is, as a CEO point of view, what story can I tell to get the shareholders off my back?
Yeah. Every quarter.
Because if you look under the hood, what are we looking at? Poor inventory management, which is an investment issue, right? Because if you want to improve your inventory cycle, you got to invest in some tech, like you said, where just walk out and it scans and charges your debit or credit card, right? That costs money, right? Another issue is CEOs don't really know their business and where the risks are, which, again, are you qualified to be a CEO if you don't know? Self-checkout might kind of open up the door for a lot of things, but it's creating a lot of other issues. Customer experience is poor, right? When was the last time you went to a store for a common item and it was locked up? Are we really going to wait 10 minutes for an employee to answer the chime to unlock?
Especially if you're at CVS and there's two people working and they're both busy.
Yeah. Workforce issues. Again, people who feel they're underappreciated are really going to put in the effort to stop theft. And again, they've cited that, it could be a pretty violent situation if they did. Customer issues. I don't know if you've heard about the meme website, the people of Walmart. People are pretty nasty. Like they one, you'd be lucky as a Walmart customer to see another normal Walmart customer. Like that's basically what it's implying. So you have a customer base that isn't so, I don't know, if so up to par as a Target audience, right? Yeah, or a Costco audience or customer base. Vendor issues and access issues. So vendor issues, we talked about the pallets where you'll sign a purchase order in your warehouse for 10 TVs, but 9 were on the pallet. But if your warehouse worker is overworked, are they going to sit and count properly? They should, but like if they have an infinite number of other pallets to count and bring in, they're going to miss stuff. And I think that goes into it too. So I think retail, to fix this, is a big, big problem. Like, I don't know if self-checkout is the answer, but I don't know if heightened security is what shareholders want to hear either, because that costs money.
To me, this is just a huge case for automation.
Yeah.
Like, why are we counting things on a pallet manually when we can scan it and we know exactly what's in there?
Yeah.
It's like, and I know that a lot of that's happening already, but to me, this is, if I'm the CEO of one of these companies, it's like, hey, what budget can we send towards automation? I know that's a scary word for employees of these companies, because that could mean that fewer people, like, it's like when self-checkout rolled out. It's like, oh my God, all the grocery store people are going to get fired. We won't need any of them anymore. But, to me, it's if this is actually a problem, you'll see money get spent to fix it. If it's fun with numbers, then it's just going to go by the wayside until something else crops up.
Well, let's say you immediately fix it and you invest a ton of money in the tech, the security. What are you realistically bringing shrinkage down to? From 1% to 0.8%?
That's the point, 1%. Yeah.
So I think that's why we believe it's like a bit of a sweeping the problems under the rug situation, because
sweeping the inventory problems under the rug.
Yeah.
Right.
Yeah.
You're hiding the fact that you have too much. I mean, Target, you highlight Target here, which got crushed on earnings.
Yeah, crushed.
They're down like 50% in the last year or 18 months or something. Inventories climbed 36% year over year. Profits dropped to nearly 90% in the quarter. Yikes.
Yeah. The big elephant in the room is Amazon. Who thinks of Target and thinks of their online shopping? I know they're improving, but still, you think of online shopping, you think Amazon. And I think that's been a big problem for the Walmarts and the Targets of the world, where they've been losing a lot of market share to, the little company up in Seattle there. But again, you don't say that to the shareholder base, right?
Right.
Because you're going to get skewered as the CEO if you do, which I think it makes that the organized crime and theft such a convenient scapegoat.
I mean, yeah, I got so many thoughts in my head. It takes billions to catch up with the speed and the efficiency of an Amazon. I'll go out on a limb and say I think one of the worst online shopping experiences is Nordstrom. Not the buying, the getting it to you. Takes forever.
Yeah.
Forever to get to you. And in online shopping, I don't know if everybody does this or if it's just me, I order like 2 or 3 sizes of like 4 things.
And you got to
so end up getting like 15 items. I take back 13 of them, right? But it takes forever to get those items to me.
Yep.
And it's like, I forgot, and it's like, is everything here? Did I get everything that I ordered? And it's the worst. But for them to, and they do use their stores as their warehouses mostly. That's partially why it comes from all over the country. But I mean, it would take billions to turn that around and try to catch up with the speed that Amazon is at.
I'm seeing a little bit of it in one of the stores I went to. I saw a lot of pickers, meaning they were online shopping for customers who pre-ordered.
Nordstrom does that, actually. They'll run around with like T-shirts, and it's like, I'm an online picker. And they go and they pull. Because I have actually ordered things before that then you get an email and it says, hey, your order couldn't be fulfilled. We thought we had X item.
Correct.
But then
because it's
we went and it was in somebody's hands. It got bought.
Exactly. But
or stolen, to your previous point.
Yeah, and I think that is a good good evolution of things. But it's not, again, it doesn't entice me to go on Walmart.com or Target.com as opposed to Amazon.com. But yeah,
Target's slightly better. Walmart, I would say, also slightly better. I would say that Walmart and Target, their online, I'm mainly speaking to their shipping, like the speed at which. I would say that those are pretty on par, but nobody's as fast as Amazon.
No.
Okay, let's move on. We have talking about that point. We've spoken about that point for a while here. So let's go to Series I bonds as we wrap up. They went up. Yes, we went on record and said they were going to keep going down, didn't we?
Yeah. But that's what inflation does. It tends to surprise. So we got a 5.27.
Inflation's been holding, keeping up. Yeah. So 5.27 is the new rate on Series I bonds. That's up from 4.3, so almost a full percentage increase. And that's for this next 6 months. So, gosh, yeah. What do you make of it?
Well, that's going to be sensitive to inflation going up and down. So based on what we've seen with the slowing of jobs and we would hope that PCE inflation would start coming down as well, right? People aren't job hopping as much or not getting as big a raises as they've been used to recently. But again, that's pretty noisy data. So that was on pretty loud summer in terms of inflation, right? What were gas prices in Seattle in the summer?
Well, I don't know. They keep going up because we had this. Anyway, that's a whole nother
California,
talk show.
Yeah, in California they pushed $6, so that plays into it. So
okay, I was just in Florida. Gas is like $3 a gallon.
Yeah, that's why Bezos is
cost of living down there.
Yeah,
there's this yogurt. There's this yogurt that we've bought before. It's this. I want to say it's a Bulgarian yogurt. It's in a glass jar, white label with red ink. If you've seen it on there. And I actually heard it on an Andrew Huberman podcast. He eats it, so I bought it. It's like, yeah, try this out. And anyway, it is. I want to say it's $12.99 at the store near us. It was $6.99 I was down in like the Tampa area. What? I mean, just insane. And of course, not everything is half, but I was just blown away at the cost of living difference over in that area relative to where we are here. Anyway, total tangent.
But I'm thinking...
Oh my God, you just reminded me about tipping. Okay, we'll end with tipping. Keep going.
Yeah, the reset period or the reset window is always based on the most recent 3 months, and we just came out of an expensive summer with predominantly gas prices and food prices coming up. So that has a lot to play with, a lot to kind of figure into the equation of the rate. At this point, though, I really don't think it's really worth the trouble to go through, because most likely it will come down. Most likely.
Well, you heard it here first. We're sticking to our story.
Yeah, we were wrong last one.
Gonna come down.
Again, yeah. Noisy data.
Okay. I was just at the Tampa airport, and I was in one of those stores, like the Hudson News or whatever, just buying a water for the plane. Like two waters, to go. Or, I guess I didn't say that. Whatever. And I get prompted to tip. I'm at the self-checkout, and it's like, would you like to tip? No. What are you talking about? I'm at a like convenience store. I'm not tipping. First of all, don't prompt me. And no. And anyway, so I finally ran into what you said, because you said you were prompted at some sort of an airport checkout.
Yeah.
And at the time I was like, really interesting. I did it. I saw it. So, God, crazy.
Yeah. And we've heard, well, I had the popcorn issue. Again, not an issue. I understand it's a small
What's your
business.
popcorn issue?
So we went to this pumpkin festival, and this popcorn stand, pre-made, he just charged $7 for a bag of popcorn. It was a one, and the thing prompted for a tip. I was like, all right, I just give this guy $1. But
Yeah.
again, he didn't pop the popcorn, or he didn't mix the popcorn. He just handed me a bag of premium popcorn. Didn't really do anything above and beyond what the price of popcorn was worth, right? $7, kind of expensive. But $1 tip is 14%. We did the math. So 14% tip for minimal effort, right? Reach over, grab a bag, and hand the customer a bag. That's it. So I think we've been saying that the tipping has gotten out of hand, and it's used to supplement certain things, but I'm still supportive of, smaller businesses, especially the one-man shop. I figured he was the owner anyway, but
Let me ask you
$8
this.
for popcorn is expensive.
Well, $7.50 of profit margin there, but So let me ask you this. You're back at the Pumpkin Festival next year. Same vendor is there. There's only one vendor for popcorn. Are you going back?
Probably not, actually.
Because
no.
the kids want popcorn. Hold on. A little bit more
Yeah.
context. The kids are like, Dad, popcorn. Like, let's get popcorn.
We got
Are you
popcorn at
going
home.
and getting popcorn? Are you saying no?
Yeah, we still are, but I'm most likely not going to tip, and he's probably going to have the same point of sale system that prompts for a tip.
Here's my thinking as I think through this. The business owner is like, hey, how can I pay this person more money without paying this person more money and without impacting my bottom line? I'll just prompt everybody to tip, because sometimes it's going to tick people off.
Yeah.
But some people are going to throw $1 into the ring like you just did.
Yeah.
And if they sell, 20 bags of popcorn per hour, which I think is probably on the low end, and 5 of those people throw a buck in, that's an extra $5 an hour for that person.
Yeah.
That's great. So I see where it's going from a business owner standpoint. Is like, hey, the generosity of people would improve the wages for this particular worker here. That's good. And I guess I get that it kind of ruffles the feathers for the purchaser in certain instances. But what I don't know is that, will you not go back? Like, I'm going to go back and buy water at the same place. I'm still not going to tip, but it's not going to totally turn me off to that particular retailer. So
I think it
this
really
is
depends on the
interesting.
source, because if we were like a Walmart or Target, and I just went through all this trouble self-scanning, they're like, hey, would you like to leave a tip for the workers? I'm like, one,
Nope.
yeah, why am I subsidizing their wages? Especially if they haven't helped me, for one. And two, even though you've had a troublesome quarter, Walmart and Target make a lot of money still. Right?
All right.
So I think it depends on the source. But the way it's presented, too, because what we're seeing is, here's a tip, you leave it, you feel good. You say no, you feel like a jerk. That's kind of the behavioral nudge that I'm getting from.
How I think we'll just pilot test when we finish a meeting with a client. We'll send them a prompt and say, "Would you like to tip?"
They'll go over
and let's
really
just
long.
see.
Yeah.
Let's just see what people do. And then we'll report back. No, I'm totally kidding. We're not going to do that.
No.
But that'd be funny, at least. It'd be a joke. We'll keep it professional, though. We'll keep it professional. Yeah. All right, that's all the time we have for today's episode. Thanks, everyone, for tuning in. Once again, I mentioned a couple times, if you have not listened to episode 34, check it out. We talked more about CDs there. And I've got to plug a video that released today on Consilio University. That is our YouTube channel. And if you are an Amazon employee wondering how to change your sell to cover elections on your stock, that's when you get a vest, some shares are sold automatically. They pay taxes, and then you get the rest. If you're wondering how to change that because you commonly have a giant tax bill at the end of the year and you don't know why, tune in to that video. I explain exactly how to do it, where to click, where to go, what to do, and how to reset this so that you can hopefully maybe not fix this year because your final vest of the year is probably coming up here in November, but you can set yourself up next year to not pay an underpayment penalty and not have such a surprise tax bill. So, little plug for Consilio U. Check it out. The latest video is all about changing your sell to cover on your Amazon stock. All right. Thanks, everyone, for tuning in today. We will catch you again in 2 weeks.
All right. Thanks, everyone.